is filling in the product management application at Bharat Pay.
अरे क्या बात है. What is the application? IPO application.
Product management application at Bharat Pay. अभी product
अरे क्या
managers को
बात
भी
है.
engineers
BMW.
work दे रहे हैं.
Oh,
हाँ.
BMW bike क्या? क्या बात है.
So every VC wants to be a PM now.
I know. यार हम लोग तो क्या है कि ये एलपी का पैसा लेके अटक गए यहाँ पे, वरना तो BMW बाइक I don't mind myself.
I'd love a session on that, making sense of the tech hiring and internally rationalizing why you became a VC.
It's a good question to have, Vatsal. You know, actually the cost of tech hiring sort of is in line with the valuation in the market and the money in the market, isn't it?
True.
They're connected. But I do feel that the tech manpower is flattening, and tech salaries will move in line maybe in just 7 years in line with global salaries, right? Because India is not the back end anymore. India is like, I mean, it's a global team, so now everything is front end now, right? वो back end का concept भी खत्म हो रहा है, at least in startups. Anirudh, welcome. Abhay, welcome.
Hi everyone.
Welcome. We normally wait till 50 people and then we get started.
What if they don't come?
Well. I mean, see, boss, so far our star speakers have pulled.
Okay, now you're putting it back.
Let's let's see what you guys can do. तो अनिरुद्ध ने लास्ट टाइम तो मतलब कुछ 70-80 तक खींच दिया था.
मैंने खींचा था. Thank you for the.
It was 80 people at the peak. How much was it, Apurva?
Yeah, around 70, 75.
75. Yeah, we had that much last time. So okay. No, with 37 now.
Pressure is on Abhay.
ये तो ऑफर पे काउंटर ऑफर आता है, ये तो बढ़ता जाएगा. हमें चिंता मत करो आप. पहली टर्म शीट आती है, उसके बाद में बढ़ता ही जाता है. Sir, Abhay, the question was, apart from making sense of valuations, how do we make sense of tech hiring?
That's easier. That follows.
That follows, right? Absolutely. Yeah. Just follows. It's the consequence of. Any other explanation? I thought it's sort of moving in line with the global salaries because its front end, back end has gone away now that everybody's working from home.
Yeah. Yeah. And of course, there is no one expected talent to be produced at the same rate as money is coming in. So there is a scarcity.
Yeah.
And if you don't have other things to attract, you have to pay up and give other things. So if it gets worse if the culture is bad.
Right.
Another possible answer is also that startups don't invest enough in training, right? We all want ready-made talent. So that limits the pool of talent you can really hire from.
Yeah.
Should we start?
Yes. Sure.
Perfect. Guys, we are at 50 now. Thank you very much. The guests today are Abhay Pandey and Anirudh Singh. Anirudh is back on popular demand. We had good fun. Abhay, last time we discussed Anirudh and Ashutosh. We discussed their journeys in their career and how and what they did, about their personal habits, how they invest time in themselves, all of that, right? Good, interesting discussion. Abhay, we all know Anirudh. He's introduced himself last time, same audience. A brief introduction about yourself, and then we'll get started.
Sure. So I see a few familiar faces. For those of you who do not know me, which is many here, I work with a fund which is a relatively young fund called A91 Partners. This was started in towards the end of 2018, sorry. and we are investing out of a $350 million fund. It's what we call a late venture early growth fund. And we made about 11 investments so far, typical check size of about 20-ish. And prior to this, I spent 11 years at Sequoia Capital. Before that, a few years in investment banking with Merrill Lynch, and 6 years with McKinsey in consulting. So I am one of those older folks who've seen a lot more, hopefully wiser.
Yeah. Abhay, we don't talk about age, particularly being sensitive to me. Nobody talks about those topics. So, okay. I'll in the first question, so we'll divide the session into two parts. First, we will discuss investing styles, right? Particularly, how investing styles have changed recently with the new Tiger strategy of raising one fund every year. Maybe it could be every 6 months. We don't know. We'll find out, right? That's one style of investing. And we'll probably dwell a little bit on SoftBank and their experience with the large checks and how they did, and then talk about some of the traditional styles, right? And how that needs to evolve, right? And how it's evolving in the context of the world. A lot of people overseas have also spoken about how they are trying to change and they're trying to adapt to the new paradigm of valuations, and hence it has repercussions, right? I mean, like in US, $100 million seed rounds are very common now, and you don't have to be Kunal Shah to reach there, right? I mean, you just need to have any decent launch product and you're there, right? Sorry. Okay, somebody liked my comment, looks like so. and it's pretty common. So Abhay, to start with you, right? Tell us about what do you think is happening, and particularly about Tiger. How do you see their strategy? What do you think are the pitfalls of that kind of fund strategy?
Yeah, so Tiger is a very well-respected name, and they have done very well in India. But the recent strategy is new and different, and has left all of us confused. It's hard to make sense out of it so far, especially because if you make investments at that pace, and I don't have the India numbers, but 180 investments in 6 months across the world with 5 partners, everyone is taking a decision every few days. And that is very, very hard to do, however smart you are. So therefore, it's got to be super thematic. And we know hedge funds are usually much better than venture funds in picking themes, and that's what they're playing to their strength, if you will. And the other strength is raising capital. So both of these are playing to their strength in a market which is evolving very, very fast. So this is their way of beating the venture capital funds, because the rate of value creation in this part of the space is phenomenal. And they're saying if we can do this at a faster pace and disrupt the VCs, it makes a lot of sense from their perspective. But I think every venture capital firm I speak to, and we all chat a lot, very few people are able to make sense of it, although very many people are happy beneficiaries of their behavior. So we all are clapping from the sidelines. But if you think a little deeper about what they're doing and why they're doing it, I suspect they're very good at figuring out fund flows around the world, and that macro is better understood by someone sitting in New York, entrenched in the global capital markets as well as they are, to say, hey, I know that a lot of money is going to flow. And let us take the India example and India tech example. Given what's happening, what was expected to happen, the China saturation, and so on and so forth, a lot of money will flow to India. And I want to predict that and be in that market well ahead of everybody else. Right. And if seeing what's happened in the last 1 or 2 weeks across China, and the subsequent expectations of capital flows into India, maybe it already starts looking like they were smart in Jan, Feb, March. Did they know this? Did they not know this? Or they knew that a lot of capital will flow into India, but now the expectations that flow is increased. And this is where they beat all the venture capital firms quite well. And there's stuff to learn from them, because we all work a lot bottom up, think a lot about a company, whether it's good or not. but sometimes the best decisions are just by being in the right markets, in the right neighborhoods at the right time. And that's what we're trying to do. It's very, very hard to do given at that pace. And most of us would not be comfortable doing that because it takes a lot of nerves of steel, not using
absolutely.
the wrong body parts, but there's nerves of steel.
Yeah, I think I mean, I presume that all of these people probably haven't done a lot of startup investing because if you and I, for example, would be doing this for last 10, 12 years, and you get used to a particular style of investing, right? It's like you are a cricketer, and suddenly you're saying, "Okay, boss, you are going to Wimbledon to take participate in the center court," right? I mean, it's a different game altogether.
Or even it's a Rahul Dravid being asked to play T20 cricket.
Yeah. which of course, okay, he did play a good innings. I remember
one good innings in many, but
one he did. Only one, not too many.
Now he's a good coach. Maybe that's the future for us.
Anirudh, so apart from doing high frequency of deals, right? Tiger also doesn't seem to be caring about valuations, right? And maybe again it's not wrong because if you predict a wave of deluge of money which will follow you, right, you still might be better off, right? So how do you see that? I mean, is it because like do you see that sometimes the valuations are a little over the top to attract the best founders to you? Is it like a marketing thing, or is it like you want to close the deal quickly and you don't want to spend like a cat and mouse game for a few weeks to get the right valuation, sense the people, just say, okay, I want to close this deal in this call and move on to the next one? I mean, what's happening there?
I think there are two. I guess one big kind of driver, as I think about it, is that if you think that you will make money in an investment, you will make money at X or 1.5x.
Yeah.
Now the quantum of that could be lesser, obviously will be. But ultimately, if you will make money, you will make money. There's no taking away from that. So valuation oftentimes is the cost of getting into a good company. Obviously, you can't overpay, you can't be out of whack, but it is also hard to obviously define what a good valuation is, right? Back in 2010, when Tiger invested in Flipkart at 40 pre, at that time, the entire market was thinking that, okay, what are they smoking?
I know. That was a moment. Absolutely.
Yeah. So at that time, everybody thought that's a nosebleed valuation, which it was for the time, right? But
yeah.
So I think it's really a function of your understanding of the market, of the TAM, of how big you think the company can be, where the value, where this can actually end up. Now, in that scheme of things, if the value is higher than what you would like to pay, and it is always higher than what you would like to pay, the buyer always wants to pay less. And the seller always wants to charge more. So there is always a mismatch. But I think at the end of it, as long as you end up making money, that's what is more important at a decent IRR, at a good MOM. And I think the second point is that it's also the power law, right? I don't necessarily agree to the fact that Tiger is today doing venture capital in the purest form, because it's not doing Series A's, it's not doing seed investing. It's hard to. I don't think it's even doing Series B's, right? They are coming in at later stages and they are saying, we think this company has proven itself and it can go from X to...
They are doing a few Series A's which sort of look like seeds, right? Yeah, 20 million.
Correct, but that's not the strategy as such, right? I mean, what I meant to say is that for a fund which is $6, $7, $8 billion in AUM, for them the bread and butter would be say $100 million, $50 million, those kind of deals.
Yeah, 100 to 500 is the bread and butter. Yeah.
Correct. So at that stage also they are applying the power law, right? Where they feel that if tomorrow if Flipkart does well and I gain $1 billion from that, I may have lost 200 million on some other deals, but then that's fine. It's the nature of the business. I guess that's how they think about it.
So Anirudh, if I were to sort of, and I'll take this question to Abhay also. If I were to pick somebody who's closer in style, somebody who's doing very quick deals, very frequent deals, it'll probably be you, right? Today.
Yeah, I guess so.
Very high frequency deals across the spectrum. I wouldn't say that you guys are doing overvalued deals like Tiger, but you are very frequent, right?
That's right.
If you don't mind, can you share How many deals a month at the pace?
I haven't honestly kept count.
Wow, okay. But then it's probably more than
No,
what
no,
I
it's like no. In this,
thought.
so I don't think we're doing that many deals. I think on the early stage side, obviously, we are a little bit more active. On the growth stage side, it's a little less the
Yeah, agreed.
frequency, but we would be doing on the early stage side easily one deal a month.
Okay. That's
So
not a
and
lot.
maybe yeah, and then on the
It's roughly
growth stage,
1.25, Anirudh.
yeah,
Not
okay, 1.25. There you go,
yeah.
Tushar from our
Thanks,
side.
Tushar.
So
Thanks.
yeah, and then on the growth stage side, the first half of the year has been busy.
All
But
right.
yeah, that's obviously a little bit more opportunistic.
Got it. Got it. Got it. So,
Yeah.
I also wanted to ask you, Abhay, that, traditionally funds were defined where a fund would typically own a stage, right? Like, for example, you guys are not a stage agnostic fund. You are like, okay, you come at a growth stage, sort of series B, C, right? C will be late for you, and maybe you probably do like a series A plus sometimes, right? So that's sort of very, very, very well defined. Typical median check size would be $20 million. Again, upper and lower boundaries. So that's sort of very well defined, right? But that's also changing, and with sort of something that Anirudh is doing here, right? Where same teams are handling early stage and late stage deals, right? Or the same fund brand, right? Sometimes the team might be different within the funds. So how do you see that? Because the traditional branding style of here, this VC is known for this. You sort of establish a brand, and then you win a deal because you were a good, like a lot of our founders would like to have in 91 at the particular stage, right, as an investor. So that's the branding. That's changing now. How do you see this? I mean, is this permanent, or this is like temporary as a reaction to what's happening all over the world?
Yeah. So if you go back a little bit in time, there were venture funds who stayed venture funds because that was a specialized business.
Yeah.
And there's some venture funds which still have remained in spite of super success, specialized venture capital firms, say Benchmark. As the venture world grew, and that venture world has itself exploded only in the last 10, 12 years.
Right.
And as that has exploded, some firms have used it to say, hey, why would we not keep owning more and more of our own companies? And I'm sure you have the same thought, saying, if I'm doing very early seed, why can't I do the series A as well? And why can't I do the series B? I know this company. I know it better than the new guy who's evaluating it. I've seen it from inside for a couple of years. The same thought went to different venture funds. And they said, why can't we expand? The Sequoia would say, I'm doing so well in seed, in series A, why can't I do a growth fund? And they launched a growth fund as early in 1996 or 95. But then the market did not exist, and they did not do well because companies took more time to grow. They did not raise as much capital. But by the time 2006-07 came, Sequoia's growth funds also started doing well. And then everybody else is looking and saying, hey, I'm a good venture fund. I can do growth as well. And I think what has happened is because everything has done well and everybody has done well, the ability of more and more people to copy that approach of saying we can play across the spectrum has grown. So I would say the largest defining factor is the venture world has grown. It wasn't this large, nowhere close to it. And then the firms at the earlier stages would want to expand upwards, which they have all done. If you have capital available, not everyone has it. There are many funds who would want to expand, but they wouldn't get the capital because the LPs will say, you have not proven yourself. Please prove yourself, and then I may give you the right to expand into the next stage. So there'll be people who will be trying to do this, and if everyone is successful, they'll start doing the same. But probably that will not happen. And whether you operate as two funds, Sequoia having a venture and a growth fund is one way of doing it. The other one is saying, let me put all of this into one product and let the same team, same set of people do it. It's obviously harder if the same set of people are trying to do both. Because, I mean, we've tried this at Sequoia, where in the morning you discuss a $3 million Series A, in the afternoon you're discussing a 50 million growth round. And the documents are different, and the people the mindset has to be different. So all we said, hey, let's take a break for 30 minutes. Let's change our mindset, start apply. Let's put on the growth hat and come back. I mean, life should not work like that. There should be some specialists. And
I want to flip that question to Anirudh also.
But if you ask that investor, he'll say, listen, I don't need a very sophisticated model to judge a company that I'm already sitting in. I know this company. I mean, somebody may make a 30-page model, but that model is useless. And there's truth to it. So the venture world is expanded. Everyone is looking good, and therefore this strategy works today.
Right.
Can it change tomorrow? I think high probability will change tomorrow. If capital gets a little scarce. But I think the venture world will not become as small as it was anywhere close to that as the 2010s and so on. So I think this hybrid approach will continue with the more successful firms.
No, I agree, Abhay. And I think, if the median unicorn in US is over $5 to $10 billion, right? Then all your mathematics, which was supposed to be at a unicorn level, they'll change, right? So that will definitely have a repercussion on A, B, C valuations. Absolutely. Which is what Anirudh was saying, that if you're going to make money, the company, it's not like defined, the company will stop at like $3 billion, right? It'll go from 3 to 4 also, 3 to 7 also. You will make money given time, right? Anirudh, you guys had the privilege of setting up a fund in a completely new structure, right? So was it like a planned thing that you will operate across the spectrum, seed to Series A? And again, how do you shuttle between the multiple hats of, like, this week a seed deal kiya, next week you're doing a growth deal?
I think both have. So so it was a planned structure where we want, Falcon Edge was already very active across the growth and late stages, and early stage Alpha Wave Incubation is the sort of arm which runs it. So I think so Abhay is absolutely right. There are two different lenses to and I don't think it is advisable for everyone to kind of start doing that, because you obviously need certain experience and certain, knowing what mistakes you could potentially make, because a Series A deal will certainly not be like a Series D deal, etc. So, I think the way I at least shuttle between the two worlds is that you just have to change the way you frame the question. For a Series A deal, if I ask a 5-year projection, 5-year model, and I say, okay, your CAC in the last 6 months was this, and the next 2 years is this, what is the reason? These are fair questions to ask, and you should be asking them to test the maturity of the entrepreneur, but that's not the basis on which you decide to do a deal or not. Yeah. And I have been in situations, and I have seen situations where certain venture funds have gone so deep into the numbers, gone into year 3 projections and things like that, where it just doesn't make sense, because how will a 6-month-old company know what's going to happen in year 4? So that's not the kind of lens, however, which I would use for a growth stage company. If it's if it's a Policy Bazaar or a Swiggy, which I'm evaluating, I have a whole bunch of data over there, and I have all the comps in the world to look at. Right. So there the lens has to be completely different. And if I go with a cowboy attitude in that sort of, where we are investing $50-100 million checks, I think that's not going to work. So the lens has to be completely different. The depth of work has to be there in both places, but obviously where you have more data, you can end up, there's a chance to do.
Challenge only is that the comps are changing every quarter here, that's the big challenge. And we'll talk about comps, right? I mean, you're right. The only thing is that, how far back in history do you go for comps? Because comps are sort of, like, I'd say the comps this year, for example, are 3x of the comps last year, right? So, I mean, and I'm just assuming that, comps will correct, right? I mean, comps are comps. They are financial metrics. They are not. They are linked to returns, right? So they probably correct also at some point. I'll come back to that. Sorry, just want to stay to this topic only. Both of you, maybe starting with Anirudh, SoftBank is now done the model. Now, when SoftBank came, we were all of us were skeptical. Here, kya chal raha hai, right? But in hindsight, if you look at it, right, I feel that they might be able to meet their 7% hurdle, whatever the internal hurdle rate that they had for some of the LPs, right? Looks like they'll be able to meet, right? And today, for example, a lot of investments in India or some of the public market valuations, etc., are sort of making SoftBank feel reasonably smart. They may not have made a lot of returns, but they actually did not buy such expensive stuff, right? And they've been proven right in many companies which have gone public recently, right? So, but otherwise, what did you think happened with SoftBank, and what are the pitfalls of that kind of a model where you are sort of trying to use money to win the winner take all market, right? I mean, that was one thing that I feel that that failed. I don't know anything else to learn from there with their approach. and what would be the right approach to, let's say, hypothetically, in your mind, to deploy $100 billion, right? Like even today, what we are seeing from Tiger is smaller funds deployed in a year, right? 6 billion, 10 billion kind of funds, right? Nobody still has a strategy of $100 billion yet. Right?
I think at SoftBank, with their fund, the way they operate, and since I've had the privilege of working with Sumer at Norvest, I think the one thing I can tell you is the approach which they adopt. I am a big fan of that, and that's something we try and use at Falcon as well, across early to late stages, which is to be thematic. The idea is to make sure that you pick up a sector which is which has real sort of fundamentals behind, which has tailwinds, education for instance, right? Or SaaS has obviously been a theme for them over the last couple of years as well, and multiple other companies, or insurance, Policy Bazaar, right? Idea is to pick up a sector which you think will do well, which you think has a real requirement, and it's not simply a fad, right? And in fact, if I were to quote Sumer right now, he uses a phrase called sector of the year. That whenever there is a sector of the year, one should stay away from that, and that's something I have believed in all over the last 10 years, right? And it's more or less it's held true. In the 2009 and 10 era, the sector of the year was the power sector. I don't know if you remember, so many companies which had filed for IPO, and a bunch of them had failed.
We all remember
Post that was the
power and so many other things, right? Those days.
Correct, infrastructure. Then there was e-commerce. Then there was hyper local, right? So that trend continues. So the idea is to stick to the fundamentals, identify the right themes, and just within that, again, identify a company which you think has the right unit economics, team, etc., etc., and just come in at a valuation which you think is reasonable, and not necessarily come at a low valuation, but come at a fair valuation. And fair valuation sometimes seems high to the rest of the world, but that should not be the criteria. So I think that, to me, that thematic style of investing, doing deep diligence, meeting all the competitors, just being disciplined about your work, I think that is what if you look at a few of their past investments in the recent past, at least, they has sort of worked for them. Again, in the SaaS space, for instance, I know for a fact that they've met at least 200 companies before they identified on the first one. Now, that kind of depth you need to have. And then if you come in with whatever value you may have come in at, right, even if it seems high to the others, that there's some rationale behind it.
Yeah,
so I think that depth and
I'll tell you, investing in a SaaS company at a multiple of revenue multiple of 15, right? And then making money because the multiples, or being in the money because the multiples are now become 30, right? I mean, that's of course, it could go the reverse also, right? That's my concern. Now today,
but that's the point. Yeah. I mean, let's say you come in at 5 times revenue, but the company goes down, you still don't make money.
I agree. No, I agree.
So my point is that, I remember there were companies where there was this one particular company which is now a multi-unicorn. I saw that company at I think sub 200 million pre. It was a 20 times revenue. Monetization had started 3 months ago. Nosebleed valuation, right? I'm like, the sector wasn't as in the news at that time. But to me, and I was honestly very, very nervous about it. But as I look back, that multiple never fell. That's because the company is a market leader. It has very strong unit economics. It has very, very, the execution has been just absolutely tremendous. So I'm saying, if I come in at a high multiple with a very, very reasonable chance of growth, I would choose that than to optimize on the multiple, but come in, invest in a company which is where the quality is suspect or is not as high as it should be. I'm not in the trading business where I'm optimizing.
I hope that you disagree with parts of what Anirudh is saying.
I do. Just for fun, because we are all. If you say I agree with everything, it's no fun. See, we are also sitting at a stage in time when the market is at an all-time high. The tech world is as inflated based on whatever you could say, and therefore everyone is looking good. I mean, I can't find an investor who's feeling that I have not done well. And especially people who've just been investing in the last 5 years, they all feel like rock stars. Yeah. Everybody. So in that context, even SoftBank is looking good. and they're looking good with chunk of money. I mean, they put more money and they're looking good, and I put smaller amount of money. I'm also looking good. So everyone feels I'm smart. Now, what Masa did was he raised a lot of money at the right time and got the macro team right that tech will be good for the next many years. And he put a lot of money into it. All of us raised smaller amounts of money and put that, and we're also feeling very good in our own small way. So, I mean, anyone from any fund is not feeling good right now, let me know. But I think whoever I speak to say,
No.
everyone is saying we're doing very well. And the more
In fact, we are feeling so good right now, aware that we are feeling miserable about other people doing well.
so it's more about the quantum of money. Whoever put more money is feeling better.
Yeah, absolutely.
So all of us wish we had more money.
Yeah.
But and historical wisdom is that doesn't hold, but right now it's holding, and therefore everyone is surprised. Therefore, if this continues, and none of us know this, but if this continues, I mean, SoftBank will look like the smartest thing that have ever happened in the last couple of decades. For a while, when the liquidity slowed down, they were not looking as smart. There were many questions being asked. But I think what they got right, in my opinion, is the macro theme that tech will continue to dominate and gain market share and gain value compared to the rest of the world was right. They made some very good bets in terms of using market leaders. They made some horrible bets, like putting $300 million in a dog walking company or something. I don't know what the thing or what it was.
Right.
But if you are playing with $100 million, what's 300 in that? That's a seed deal for you. So it's okay. You can take all kinds of risks. So I think it's a tough time, a very difficult time to judge anything, to say someone is good or bad, because everyone is looking very good. When the dust settles, and I don't know when it settles, then we'll figure out who's good, who's bad. No one knows.
Yeah, Abhay, so that's the point, right? I mean, right now, even relative benchmarking may not be appropriate to evaluate how you are doing well, because these are irrational valuations, and I want to come to some sector-specific valuation discussions.
It's just on that, Anand. I don't know if these are irrational, because as we said, is 15 the right multiple for SaaS, or is 25 the right multiple? We don't know. I remember in 2014,
I agree.
there was an expert in Sequoia who said, I'm the SaaS expert, and this is not India. We didn't know SaaS. Axel was doing SaaS well. India was struggling. But this global guy came down, did some math, and worked his hands on a computer like he was playing the piano, and then came out and said 7 is the right multiple. And all of us said, oh wow, that sounds right. There was some deep math going into it. And then the 7 held in Sequoia for 1 or 2 years, then 7 became 10 and 10 became 20, and who knows what's the right number.
Yeah, I know. So and Anirudh is right. I'll tell you, the number 30 with 2 years of growth of 100% or more will actually end up at being 7, right? I mean, that's the point. So if you really pick a winner and the company grows by 100% for 2 years, you're back to 7, and actually you look like a rock star.
Yeah.
And I think this method of discounting only the next 12 months of earnings, maybe that is flawed, right? We probably take a bet on the number 1 and say, okay, boss, ये तो 5 साल तक grow करेगा ही करेगा, and maybe I discount the next 5 years instead of next 2 years only, or next 1 year only.
No, but Anand, just to be clear, that's not how I or people others at Falcon Edge also will value a company. I mean, that was just an example.
No, I agree. No, but I agree with you. It's just that, historically, if you're used to 5, 10, 15 as the number of SaaS multiple, suddenly last 6 months it becomes 30, 40, 50, right? And I like look at let's talk about SaaS multiples, right? I mean, how do you make sense of multiples of 20, 30, 40, 50, right? I mean, and these are companies which are probably, maybe 10, 20 million revenue, maybe growing at 100% a year, and are unicorns already.
So this one is not so difficult, Anand. I think it's more a function of your understanding of the market, because at this scale, if the market is deep enough, it doesn't matter what multiple you pay. If the market is deep enough and you are a very credible player, because a couple of years of very solid growth can take care of your 15, 20, 30. But if and even in the US markets, you can see the high growth, median growth, and slow growth multiples vary a lot. I mean, they vary between 20 and 8 or something, right?
Yeah.
So and then the best companies trade at 50 times. There'll be at least 5 or 7 companies that trade at more than 50 times, and these are very large companies,
Public market
growing at
companies,
about 40 to 50%. They're not growing 100%. So if there's an Indian company which is a 10-15 million run rate, but you can be sure that they'll grow at closer to 100% for a couple of years, you can pay whatever multiple you want. I think the challenge is it's harder to figure this out in many situations, and sometimes therefore you end up taking a little bit of a educated guess, saying this is the growth because the market is complex, it's evolving, and there are many players who are competing in this market. So that's figuring out the market is harder. If you figure out the market, then the multiple is easier.
Yeah. So, Anirudh, I mean, we've spoken about SaaS. I want to talk about, consumer platforms like Zomato, right? I mean, now, इसमें क्या हो रहा है कि in a SaaS company, one thing you are sure of is about profitability, right? I mean, reasonably certain because of very low costs, very high margins. You sort of know that, okay, this will be a profitable company. In a company like Zomato, even that is a probability. And now what's happening is that, when we invest at seed stage, we say it's day zero. Obviously, it is day zero, right? Then when Abhay comes in or Anirudh comes in, it's still day zero. The company goes to IPO, it's still day zero. Because, to make sense of valuation, how do you make sense of valuation? Because it's not just a multiple game which will correct. It is also a probability game. Whether there will be a profit in the next 5-10 years at all or not. Right?
I think it's the same, discussion people had when Uber's S1 came out. One of the risks was that we may never be profitable.
Yeah.
So, right. So I think it's so it's a very, very fair question. And ultimately, if you ask the purist in me, then yes, I would not, the debate. I mean, a company's job is to be to generate profits, and that's how you build value. But ultimately, I think, as far as profit goes, uske bhi there are different definitions, right? Like if you see Amazon is maybe break even or profit, zero, but on a cash flow basis, it's positive, and so the money is being generated in the core business, but reinvested elsewhere. So that's one way of looking at it.
Yeah.
Same for many. Yeah.
Anirudh,
You were saying something.
Amazon was the longest example of a company not
Correct.
profitable. However, at the same time, they did not also raise a lot of capital after going public. They went
Correct.
public,
That's true.
they just stayed near break even. So
That's true.
they were not needing capital, right? So that's my math. It's okay if you're not profitable. It's okay if you don't give dividends. That's fine, right? But how do you model a company where not only you don't know whether the profit will be there, hence probability, you also don't know how much capital will go in, right? And at what price. So how do you judge that kind of a thing?
To me, I won't speak about Zomato, obviously, because I haven't even seen the numbers, barring the research or whatever. But yeah, in general, to me, I would not be interested in models where there are questions on monetization, because there have been in the past few months or couple of years, there have been some companies which have raised a lot of money at very high valuations on the back of engagement metrics and without any monetization. So that, or where models where profitability is suspect, at least, or even on a unit economics basis, right? Because sometimes on a unit economics basis, you're profitable, but yes, as you expand, you scale, you will have losses. But if even on a unit economics basis, you're not profitable, if you just inherently as a core model, you can't show profitability, I personally would not want to. I would have negative views on such a business. I would not want to invest in a business where there's a lot of momentum, a lot of engagement, and a lot of scale, a lot of expansion. I mean, if you give something for free, obviously a lot of people will use it, right? I mean, an example of this is lending. I mean, growing your AUM is the easiest thing to do. I mean, just lend out money. Who's going to say no? But then it comes back to bite you 2 years later when the credit costs go high.
So, Abhay, I'll come to you. Anirudh, see, we say that lending, you can grow AUM and you may not be profitable. Interestingly, we have billion-dollar companies where they haven't even started lending. So they are already unicorns. They have threatened to start lending. Then they will do lending, and they may or may not become profitable, because lending, as you said, is a tough business, right? So how do you sort of model valuations of these kind of companies? We just want to understand the technique, or is it just simply supply and demand? Is it the kind of thumb rule that we do? Like how we value a company is, boss, mujhe $500,000 डालना है, I want 10% of the company. That's how I say valuation is $5 million. That's the thumb rule we work. I am sure Abhay and you also do thumb rules in maybe even Series A or A plus or sometimes Series B. But at like a $2 billion, how do you do that kind of a math? I mean, if you have something to throw light on that, because
I mean, I would do it the same way I would evaluate any other NBFC. I used to be at Norwest, and Norwest has done thanks to my
yeah,
experience there, I've done a fair bit of NBFC investing, etc. I would not change my lens. I
okay.
would use the same models. I
You're
would
party
test,
pooper, Anirudh.
but unfortunately, but that's the truth. I would test for the same assumptions, and that's whatever value it gets me to, it gets me to. That's what I would do.
Abhay, like, how do you think people are valuing this? I know you wouldn't do it again, so you are also a party pooper, but
No. So sorry, you're saying you're talking about a specific company.
no, I'm talking about a company, any company, right? I mean, and let's not name a name, but a company which just doesn't have any revenue, which
Yeah,
is primary revenue is going to come from, let's say, lending, right?
it's getting like narrower.
Yeah,
Yeah.
yeah. Getting narrower, of course. Yeah. So, so how do you value a company like this, right?
I don't know that trick. I think getting up to the $50-100 million in today's market is you can justify some things saying why.
Yeah.
Beyond that, given the size of the outcomes which have not been proven, just based on a TPV of transactions flowing through my platform, and therefore, if I could do something with that transaction, it is very, very hard. So I don't understand it. I don't want to understand it. It's okay. There's some things you don't need to know. You don't need to know everything.
You know,
Anand, you will have to stop recording if you want Abhay to say anything or Anirudh to say anything, right? Or even for me to say anything.
well, you seem to be keen to say something off the record. We can stop recording, Apurva. You know, अबे टाइम कितना है यार मतलब Zomato का we all read right DRHP right I mean I'm sure like everybody's enjoyed reading like 130 pages starting with page 130 137 or something there are the monthly users are 10 million only right now I'm assuming ki 99% overlap between Swiggy and Zomato everybody shops between the two apps for discount hopping that's the TAM I mean why is the TAM very large मतलब and do you really think that's going to change? Are we misreading the market by saying there are 300 million internet users, right? But TAMs for typical individual products, let's say an Urban Clap or a Zomato, or even like a Paytm of transacting TAM, has been significantly lower. Right? So is the and the value that we can ascribe to that TAM is again even lower, right? I mean, Zomato probably makes like $1 on an average of revenue per sale, right? So to do like $1 billion of revenue, you will need like at the current frequency of ordering, you will need the TAM to be doubled or tripled, right? I mean, from the current number, right? That's not going to change. I mean, or what do you guys think about that? Is this a story where the TAM will increase dramatically? Because today I don't see the TAM.
No, today you can't, but I think I'm trying to justify. Don't take it as what I believe necessarily, but the people who believe in this would argue that the leaders have been established that 1 and 2 or 2 and 1 will not change now forever, and therefore let's wait for the time to come.
Okay.
All this will mean is you'll have somewhat of a deeper J curve, but capital is available and will continue to be available. And eventually when the dust settles, which is 10 years, 12 years, 15 years later, when the time arrives, there will be only 2 players to play and they'll be very large. And the fact that India is the only country where internet came before purchasing power. In the US, purchasing power came first and then came the internet. In China, both came together. Companies which are internet first and are being built like this will be more powerful and more deeper entrenched than their peers overseas, because even a Meituan is dealing with a bunch of food services companies that were well established, and therefore there was some pressure on take rates all the time. In India, Zomato's pressure on take rates, forget political pressures, etc., will be lesser. They'll be able to keep charging more and more.
No, they definitely, as a percentage, they have been able to charge much more than global countries.
And that's because the Indian infrastructure on food services was less established, and therefore the internet first players are able to charge more because they're creating the market. They will facilitate cloud kitchens and whatnot, and therefore they can possibly pull it up to 30% till the politicians come in, and therefore once the TAM comes, after having spent a lot more money over the next few years, it will be a much stronger, bigger, better company than a Meituan or a DoorDash. And therefore, let's give it a valuation. Now, that still does not justify 111,000 crores.
Yeah, I can imagine.
But you can certainly justify a reasonably high number that you and I wouldn't have thought of.
Definitely justify being invested in Zomato,
Yeah.
right? But today to make a buy is a difficult one. But Anirudh, I agree with Abhay, right? I mean, if number 1 and 2 are sort of visible and you're sort of confident that these are number 1 and 2, TAM will come. What is your horizon? TAM will come someday, per capita income will come someday. How are you thinking about that?
So
Because this is about it, right?
that doesn't matter about when. If everyone keeps believing TAM will come, then you as an investor today will be okay, because the guy coming in 5 years later will also believe TAM will come.
Okay.
And therefore things will stay expensive.
So,
Now, will it be 30 times revenue, or will it be 20 times revenue? Who knows? But it'll be a high, expensive multiple that it's hard to justify for people who haven't seen these kind of numbers.
Anirudh, if you remember, I don't know if you were tracking the markets those days. 2007-8 के अंदर ना एक McKinsey की study चलती थी बहुत बड़ी, middle class वाली. They had this in pyramid and all of that, how the pyramids are changing and the various buckets and all of that. The entire middle class story was proven bunkum, right? And practically the first lot of VC funds in the country was following that thesis, right? Are we seeing the redux of that now? Or you also believe, okay, maybe 5 years away, 10 years away, TAM is coming, per capita consumption power is coming?
No, I think, see, from a very first principles perspective, and again, my years of experience is definitely lesser than you or Abhay, so I'll, please take my opinion with a pinch of salt. But what I have seen in tech is that when the TAM comes, it comes in a much bigger form and much faster than you would expect. And sector after sector, at least so far, we have seen this play out. We've seen this play out in cabs,
I agree.
in food,
I agree
in insurance, in everything, right? Yeah. So when the point is, if you think that the market, that the number of potential buyers exist, then there's no point trying to time when they will come online or when they will start buying from you. If your product or your service is good, I feel they will come. The need is there. They will come sooner than you expect. So for instance, I'll give you an example, right? Swiggy Series B, I had modeled in year 4 or year 5, 150,000 orders per day. Okay, this was back in 2015. And in 5 years from then, they were doing 1.5 million orders per day.
Yeah.
And I had used all sorts of analysis to say, okay, 150,000 ka ye math rationale hai, this, that. Right. But yeah. I mean, that's just one example and doesn't have to hold true for everything. But my point is that, when the TAM comes, if the need is there and the tailwinds are there and the service or product is good, the TAM will come far sooner than you expect and in much bigger forms. So that's what I would say. Now, when it will come, I mean, there are all sorts of research reports.
No, and
who
that's
knows when,
fine. When it will come is fine, because if the cost of money globally is very low, they can wait, right? I mean, it doesn't matter. You are anyways looking at an alternative return of 1%. So
yeah.
TAM 10 saal mein bhi aata hai, to you're still okay, right? I mean, TAM will come and you're already into a winner, right? I think that's the mindset. So, I mean, there is some justification, but there are some new sectors emerging now very recently, and we are struggling ourselves to how do you value and what will happen to the company. Some of them are like B2B marketplaces, right? And these are sort of, again, very complex, difficult businesses, which I also don't know whether there can be a winner take all. Zomato is a consumer behavior, right? A lot of brand loyalty, a lot of stickiness because of switching costs, etc. Behavioral brand affinity, etc. With a number one, network effects on the ground. There's a lot of things, right, which go into deciding a winner. How do you view and value a company like Udan, company like Infra Market, company like the B2B marketplaces, right? Which sort of are not necessarily even internet companies. They're not high margin, right? So I don't know how public market will view them, because the margins are in some cases low single digits, right? So how are you thinking? I mean, have you done any deals in those spaces, and how are you thinking about valuations in that, right? Like there's a multiple of GMV, or I don't know how you value that.
You're asking me or Anirudh?
I'm asking you, Abhay.
So my many of these businesses are in my opinion, providing loans to poor quality borrowers
Yeah,
without a collateral.
agree with you. So they're basically doing distribution where traditional distributors don't want to go because of poor, they don't want to give credit, or the unit economics don't work because of low volume, right?
Correct. Now
Yeah.
you layer that with tech and you start making it look more attractive. But these are very difficult businesses, and the reason they've been fragmented is for that reason. Collections are hard and uncertain, and so on and so forth. Now, can you put up a lot of so-called bulk commodities on a platform and expect a very unsophisticated buyer to go on a platform and buy it? They don't. So it's really a physical world transaction which is being routed online,
Yeah.
just to show it like tech, and then you get your 1.5% per month as
Abhay,
margins.
I agree with you, right? I mean, some of the businesses look like they're lending cement and steel to poor quality borrowers instead of money. That's what they're doing, right? I mean, lending a commodity. And they're also delivering, and they're also bearing the delivery cost for you. So
Yeah.
even better, right?
So
So
finally, all you should make is the cost of capital for the borrower. He's happy to pay 2% a month, and if your working capital cycle is 2 months, you get 4%. But this as a lending book would be a horrible book, but as a tech-enabled marketplace looks very attractive.
but that apart, assuming that there is a pocket of profit here, right? Let's say in pharma, disjointed industry, not a commodity marketplace, or let's say in exports where you have to do a lot of control and quality check on manufacturing, whatever. Maybe there are some pockets of profit. I don't know which ones are.
So they take pharma, and the US market is a good example. It's consolidated, 4 players, all
Yeah.
of them make 2% EBITDA margin, trade at 0.3 times, 0.4 times sales, and
Okay.
on very large volumes. And that's what
Yeah.
these
Good
businesses
volume.
should be. But in India, we made these businesses 2 times GMV while they're 0.3 times revenues
Yeah.
in the US markets.
Yeah. 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 And that's a big gap, right? I mean, this is sort of like a gap of probably a 10x of on the multiples, right? Eventual multiples, right? So, Ayush, how are you thinking? I mean, have you done a deal like that? And if you can share about how are you thinking the valuations will develop in this in terms of, let's say, a multiple of GMV, a multiple of revenue. The good part is that, with Zomato IPO, we are all thankfully talking about revenue multiples, right? That's a good discussion and a good shift, right? I think for the first last 2 years, till a year ago, I hadn't heard the revenue multiple thing in the right manner. People will say revenue multiple, they mean GMV multiple normally.
That's true. No, I think I don't have very different opinions from Abhay. Ultimately, uh, you know, entry valuation is one thing, but if you can't believe that at the time of exit, if the company can reach a point where you can value it on a more fundamentals basis and saying, okay, this is a tech company, so let me give it this value because it's a nice fancy marketplace. I mean, I have to be able to see that path. Second, I think the only difference between some of these companies could be that they are maybe a little more global than what the conventional Zomatos of the world. I know Zomato also tried to, had global operations, but these companies inherently, I feel there is a global need, so they could potentially go outside India as well. I think there could be that one difference which one should factor in. But again, from a more analysis perspective, it will not differ too much, at least at exit. Entry, yes, you could value these companies off of GMV or revenue or what have you, but at least when it comes to exit, I feel
Should be
very
a profitable.
uncomfortable valuing them off,
So
and I
EBITDA.
could be wrong. I'm happy to be proven wrong and be given a higher multiple. I mean, I'm all for it, but at least in my analysis, I'd want to be conservative.
All right. Guys, we probably have two wrong guys to talk about valuation in this session. We need to do this again. No, thanks for your perspective. It's good to hear sane voices. We want all of us to think fundamentals, right? I mean, it's perfectly, like I said, it's perfectly okay to give overvaluation to a great company, right? I mean, that's okay. Everybody wants to compete. You do want to own the best company in the sector, right? I mean, there's no point in owning the number 3 player in the market. So opening up to questions, just last 4 or 5 minutes. Anybody? I read out the one question that is there in the chat, but anybody? Apurva, Shruti? Okay, let me read out the question with Vatsal has posted. is this greater fool game? Is this a reality? Because, sometimes as outsiders, everybody ends up thinking that this is a greater fool's game, right? How does it work? In fact, sometimes even analysts from good firms, they also get flabbergasted कि हम लोगों ने क्यों किया ये? So
Who should answer it, Abhay or?
yeah,
I think
yeah,
Abhay should answer it.
Abhay should answer it. Yeah.
I'm sure analysts from all firms think why their partners did some of the deals they did, but
No, I'm talking about the pricing.
Yeah.
Particularly pricing.
I know. I think this is. I don't think anyone usually plays the greater fool theory at the time of investing. At the time of investing, you really think that you found a gem, you found something at a good value, or you're seeing more than others are seeing, and you may be proven wrong. But this is because liquidity is very, very hard to predict, and especially the VC firms are very poor at doing it. The hedge funds can do it much better because they're sitting in better positions, and they may. I don't know if they do it, but they may be. As I started off by saying, Tiger may be playing that. That's benefit of doubt, saying they know better on capital flows. We don't know a whole lot about capital flows. We can predict what the next 2-3 months may look like on capital flows, but not beyond that. So we don't, and I suspect none of our VC peers do.
Yeah. So does it mean, and both of you can answer, do you expect now that, Zomato valuations are some kind of a benchmark for an equally dominant, duopoly player in any space in India? Will that sort of be the common story going forward also?
In the near
future, I think it depends from. Sorry, please go on, Abhay.
Oh, okay. In the near term, for certain, I do think we'll certainly see upgrades on valuation expectations on an ICA delivery and a policy bazaar and whoever else is coming. It will happen, and all of them will move from 2 to 3 to 4 to 5 to 6 and get listed. And by the same logic, saying if that is 35 times revenue, we why shouldn't we have better profits, etc., right? And till some party spoiler comes and screws up the market, or the Fed comes in. Till each of these two things happen, one of these two will be spoilers. More likely the Fed than a party spoiler, because the markets are a lot more
flow-driven.
Yeah. So overall, I think the next 12 months we'll see a lot more of this. That's the expectation I have.
Okay. Anirudh, anything to add?
No, nothing much really. I think, I think some of these valuation, I was thinking that we're at the peak of the bubble, but now after this whole China stuff, I would imagine a lot more.
Some more peaks.
Some more peaks to climb. So.
Okay. No, I agree. And I think it's a good perspective that I think China will the money will have to go somewhere, right? I mean, I think it will be very difficult for global investors to look at China for the next few years. They'll probably wait for a regime change. I mean, I'm trying to find it difficult to imagine how people will go back again to China, right? So a very small portion of that money diverted to India could be like really large and meaningful, right? We have Rishabh raising his hands. Maybe the last question of the day.
Yeah, I think this question would be more for the VCs who have seen cycles of kind of bubbles. So the question is, specifically for Abhay, we discussed a lot about late stage and growth stage valuation, but also at early stages, at seed stages or Series A stages, the valuation is skyrocketing. So in that context, wanted to understand or gain some practical insight. What do you think of it? How should an associate or senior associate or a partner at a firm at early stage investment think about investing in companies now? Do they take thematic themes and then build more conviction around investing? Because ultimately we'll get the same percentage stake that we would have got earlier with the, let's say, now increased ticket size of, let's say, $1 million. What has been your experience?
No, so experience as the market has kept expanding. If you go back to 2010, even the US markets were wondering whether the US Series A market, for example, had expanded and had become irrational because the Series A rounds had gone from $3-4 million to $8-10 million. And they were saying, oh my God, this is not sustainable. And we were complaining, oh, India is also $3-4 million or $5 million. So India was similar to the US when you're complaining. So, but the markets have kept expanding. and kept accommodating all this expansion at the early stages. And so far, we haven't seen anything go wrong. So till something goes wrong, this will continue and this will go on. How should you think about it? I think you should do what you feel comfortable about. If you're able to see a potential market size, then it's okay. It doesn't matter if you're doing seed and you're paying up for something that you believe is going to be very large. It's okay. But I suspect, given the India market size in most cases, if you are paying large amounts of pre-money on seed rounds and owning low dollars, high probability that you'll go wrong. That's my sense. Given we're still a 2,000 per capita economy, we are not the US or even China. I mean, the 2,000, 15,000 makes a lot of difference on every consuming company. Yeah, if it's a SaaS company, doesn't matter. You can think as the US markets. But anything with the Indian consumption story or Indian B2B story, etc., you have to be super careful.
Got it. So essentially, game change ho gaya hai. Instead of 50-50, it's now 20-20.
Well, by the way, like Anand was saying, peak is changing. So the games will also keep changing, right? As the peaks keep changing. Fabulous discussion today. I mean, a lot of fun. Absolutely a lot of fun. Thanks, Anirudh. Thanks for coming again. Abhay, great to have you as always straight shooter, and couldn't have thought of better people to host this for us. Thank you very much. Bye, guys. Thanks a lot. So we reached
Thank
the
you,
peak of
everybody.
80. Thank you.
Bye, guys. Take care.
Bye.